On the Tape is presented by CME Group, where risk meets opportunity. iConnections, reimagining how the investment industry connects, and SoFi. Get your money right all in one app.
All right, welcome to On the Tape. I am Dan Nathan, joined by Liz Young. Guy Adami is in parts unknown. He's actually doing something that nobody really wants to do, but doing his civic duty this morning. He will be back to us later this week. Liz, welcome back to the pod.
Hey, happy Monday. Packers big W this weekend.
I was going to say, your pack is back. They're back in the playoffs. You must be excited about that. But their former coach is hosting them down in the Big D. That is going to be a tough one this coming weekend. We'll see, though. It's a good run for you guys. 6-2 in the last 8 games of the season.
It's not over yet. Stop talking like it's over yet.
Well, there you go. I mean, listen, this Dallas team has been known to let their guard down, but I don't think Dak is going to do that. He is on an MVP sort of run here himself. But a little housekeeping really quickly after Liz and I go through everything going on this week, which actually the week is capped by bank earnings. We're going to have plenty to say about that. We're going to talk a little bit about what's going on in the oil patch, some interesting news out of the Red Sea causing a couple things to slip. One of those would be shipping rates. The other would be crude oil, and that has to do more with Saudi price cuts. But Guy and I had a great conversation late last week with Kenny Chung. He's the executive director and portfolio manager in Hong Kong of the Astera Capital Fund. And we talk about a whole host of things going on with China, the private credit markets, what's brewing, I guess, in their property markets. We talk about some of the geopolitical issues over there and really just the state of the Chinese economy. So stick around for that. That was a great conversation, Liz. But we got to start with the Friday, December jobs report. We saw the 10-year yield get back up above 4%. It's there right now. We've seen the dollar rally a little bit here. It's kind of an interesting juxtaposition between some of the things that were causing stocks to rally pretty aggressively in the last 2 months of last year. We're seeing the S&P down 1.5% in the year. We're seeing the NASDAQ down a little more than 3% or so. And some of those kind of inflationary sort of headwinds, if you will, to the economy have kind of been perking themselves up a little bit. I know 1 week does not make a year in markets, but we've seen a bit of a reversal in narratives in a very short period of time. And I'm just curious, like, what did you take away from the jobs report and some of the kind of reactions that we saw? And is it just kind of a little reversion, after we had such a sharp rally in equities and such a sharp sell-off in yields and some other risk assets that are supportive of equity prices?
Well, I think the reality of it is more that the market got ahead of itself thinking about the idea that, okay, all of the economic data seems to be coming in solidly, yet at the same time, somehow we're going to get all these cuts and we're going to get them sooner than we originally thought. And all of that together is good, when it's not exactly all good. Because if you think about when the Fed might cut, that would probably cause a resurgence in inflation if they did it too soon. So the report on Friday was actually really interesting. If you look at just the headline data, the jobs added, pretty strong, above consensus, which you could take away. If that's the only data that you looked at, you could walk away and say, you know what, things are pretty good. And if you look at the unemployment rate, 3.7 came in below consensus and stayed steady versus last month, you could walk away and say, things are still pretty good. Labor market is strong. Everything's okay. Peel back the onion a little bit more and you find out that hours worked are down, and the labor force participation rate was down. So there are some things under the surface that should give us pause. And the hours worked piece in particular, especially during a period that usually hiring goes up and work goes up because of the holiday season, hours worked came down. So some of those just, and again, not a trend, not something that's telling us, oh my gosh, ring the alarm bells, but things that are just inconsistent under the surface. And then the market's reaction, particularly the yield reaction, I think was rational. And now we've gone from, we were pricing in 6 cuts all year. Now it's back down to 5 cuts. So I think some of that was rational. Stocks had really rallied on the drop in yield. So again, stocks having a little trouble finding more durable upside as yields rose again.
Yeah, and I guess the CME Fed Funds Tracker is pricing now about a 65% chance of a 25 basis point cut at the March meeting, right? So we know the next meeting comes at the end of this month, and there's really nothing priced for a cut there. So it's interesting when you think about, again, you know, the 10-year at 4%. The last time the 10-year, we have to go back, was basically 4% about 4 or 5 months ago. We had an S&P that was much lower, right? And so it's interesting to me when I look at some of the big drivers of S&P performance last year. I see Apple down 5%. I see the SMH, which is the ETF that tracks semiconductors, it's down 5% of the year. Some of the other big names, Amazon's down, almost 5%. Some of the other ones are down a bunch here. So, talk to me a little bit about this notion that the stock market was broadening out a little bit, right? So we had people are very focused on this equal weight S&P, the RSP, right, which is down about 1.3% on the year versus the market cap weight, which is down 1.5%. So that relative strength with some of the biggest winners, down much greater than the S&P, tells you that there is a little bit of rotation that has happened. Is this a theme that you think is going to continue? Because all weekend long, as I was reading different strategists, whether they be sector strategists or industry analysts or broad market strategists, they're talking about how this is going to be a great stock pickers market. And it's funny, it's a similar narrative, Liz, that I heard in early 2022, right after the big run up that we had in late 2020 and 2021, when everyone knew there was a lot of froth in the market, but they were convinced that it was going to be a great stock pickers market in 2022. And what we did see, though, is that correlations basically went to one. We had a good old-fashioned bear market in 2022, right? So I'm just curious how you think about that sort of narrative, and does it harken back to some of the narratives in early 2022?
Yeah, I think it does, but I don't think, even if we do have a down year in equities this year, I don't think we're going to see the same experience. So in 2022, if you remember, the big headline towards the end of the year was, oh my God, the first time in, I don't even remember how many years, stocks and bonds were both down double digits. And it was this huge event that the 60-40 is broken, diversification doesn't work, it fails you when you need it most. If we do have a down year, if we have some volatility in equities this year because we're embarking on this cutting cycle, because maybe those legs are finally going to get themselves through the system, I think that treasury bonds would actually act as a hedge. So I don't think you're going to see stocks and bonds both down like that. I do think diversification would work. But back to the original idea of the broadening out of the rally, since the end of October, it absolutely did broaden out, right? We had, like you talked about, equal weight S&P had really come off the bench. A lot of the sectors that hadn't done well, banks were up 20%, I think, since the end of October. Look at things like small cap. And interestingly, small cap, I think this is what we need to watch now for the next month or two. Small cap stocks are going to be what tell us whether or not that broadening out can continue. And if you look at charts, if you take some of these charts back a longer period of time, let's ignore the Dow for a second, because I know the Dow made new all-time highs. But if you look at things like the Russell 2000, the S&P, obviously, I wouldn't even say that we had a reversal. I think we had a failure, right? We tried to get to new highs. We tried to continue that trend upward through some resistance levels that are pretty obvious on a chart, and we couldn't quite get through them. Now, that doesn't mean we won't, but for this period in time, we haven't gotten through them. And the last point I'd make, especially in small caps, is there are two indices that track small caps that are pretty widely used. You've got the Russell 2000, which is all encompassing, and it just really mainly includes companies based on what their market cap is. And then you've got the S&P 600, which goes through a profitability screen. Generally speaking, in a risk-on environment, you would expect the Russell 2000 to do much, much better than the S&P 600 because some of that junk and trash will rally and people are just throwing caution to the wind. In that period from the end of October through the end of December, both indices were up about 23 or 24%. There was almost no dispersion among performance, which tells me that it was just indiscriminate buying, right? Didn't really matter profitability or not, didn't matter quality or not. It was based on macro factors. It was based on the environment more than it was based on the fundamentals of those companies. So now here we are, the macro factors, some of them still the same, but the yield piece obviously fighting against us in that realm. And you're seeing some of these stocks that had showed broadening out fail at those upper levels.
Yeah, no, and I think that's a great point. Guy and I talked about the Russell last week on the market call a little bit and how it's been trading between this range, just about 1,600 on the downside since about mid-2022, and that's off of an all-time high that it made in late 2021. It broke out after a long consolidation and got above 2,400. So a lot of folks were saying that was the sign of the broadening out in late 2021, and it got everybody in, and people got really excited about small caps because what it it said about possibly the economy inflecting after a very difficult couple years with all the monetary and the fiscal stimulus, and this was the confirmation. But then when it was a failed breakout, it led to the downside. I think that's kind of what you're saying as far as you're not making a prediction about what's going to happen. You're basically saying, follow this, because it did work in 2021. And it's interesting. Again, Liz, we've had this very long consolidation, again, in that range, which is a pretty wide range, right? And to your point is that the Russell 2000 off its October lows rallied nearly 27% to its recent highs about a week and a half ago, outperforming the S&P, which is up about 16% or so. But here we are now. We're down 6% from those levels. And again, could it just stay range bound as it has been for the last year and a half? Sure. But the inability for it to break out is probably saying a bit more about what's going on in the economy. And I think that's really important to break out that other index that really screens for profitability, because we know that a lot of these companies are very unprofitable. We know that their cost of capital is higher, so they're more interest rate sensitive in a way. So that's something I think that makes a lot of sense to keep an eye on. Let's go back to the economy, though, and putting a button on this whole issue as we're talking about what that jobs report really means, because it does speak a little bit, Liz, to the soft landing narrative, right? Like, it was better than expected, but softer than a year ago, period, right? And so, like, and if you're pulling apart some of the internals of it, we still have, though, on the outside, a 3.7% unemployment rate, which screams at 50-year lows, but we are seeing a softening, right? And so that does speak to that kind of soft landing. Now, your concern would be if we were to have a precipitous slowdown, right? Then that would be the kind of harder landing scenario that markets are not priced for right now.
Right. Well, and Guy and I talk about this all the time. The unemployment rate and some of these jobs numbers don't show cracks until they do. And then when they do, it goes fast. So obviously right now we're not seeing cracks in the labor data as it's been reported. But when you think about what could happen as softening continues, and I think most people, even bulls, expect softening to continue. In fact, almost welcome it, because we do want inflation to be completely solved. And you can't entirely solve inflation without continuing to soften demand and soften some of the labor market. It's all connected. But if and when things do start to slow down in the labor market, it's very difficult to ride that teeter-totter and keep it above ground on both sides, because as soon as things start to go over the other side of the hill, it's like a boulder rolling down, whatever analogy you want to use, a snowball rolling down a hill, and it picks up a lot of speed, because a lot of companies look around and say, oh, well, they did it, now I can do it, right? And then you're not necessarily pegged as the one that cut jobs, so your fundamentals are bad and everybody else's are good. If it feels like everybody is allowed to start cutting labor, everybody can start cutting labor. And then that's where you get the steam to pick up. There are a couple other things, if you, again, peeling back the onion in labor data, the headline data, as I mentioned, still pretty good. I talked about the underlying stuff in this report on Friday. There was another report, the quits rate. So we get JOLTS number. Part of the JOLTS number is the quits rate. And I always talk about the sequence of events. You have to remember what the sequence is going to look like. It doesn't just go from 0 to 60 overnight. The sequence is that back when the labor market was really, really tight, there were 2 jobs for every unemployed worker. You had a quits rate that was really high because people felt confident quitting their job. They would find another one, or they already had found another one, and they felt good about the labor market. It was an employee's market. That quits rate has fallen quite a bit. Now, it's not necessarily in a concerning place, but it's fallen quite a bit in the sense that employees are now feeling like maybe I should hang on to this job a little bit longer, or it's tougher to find new jobs if I decide to quit voluntarily.
Yeah, and I guess the bigger issue for that is that those are largely, I think, knowledge jobs, right? So they're higher income sort of jobs. And we've seen, we started out last year with a whole host of big cuts from some of the biggest tech companies, who had been on a hiring binge in late 2020 into 2021 and kind of pulling back from those levels. It seems like on the lower end, there's still plenty of demand for those sorts of jobs, but those aren't the sort of jobs that can power, an economy, right, that is expected to downshift from, 2.5% to maybe 1.5% from a GDP perspective in 2024. I want to switch gears for a second here because it seems over the weekend that, the House and the Senate have a spending deal, which hopefully could avert a government shutdown. And if you look at some of the trends within that jobs report, the government was a big part of the gains, right? And so the question I guess I have is, are we going to be faced with another own goal, you know what I mean, by our legislators, you know what I mean, that could really slow down, you know what I mean, whatever sort of recovery or the pace in which is keeping things, I guess, keeping things from falling apart a little bit, because there were some times in 2023 where there was some trepidation about a government shutdown and what that might mean for an economy that was really, holding on for dear life, if you will. And make no mistake about it. I mean, Fed Chair Powell said this a little less than a month ago, 1.4% expectations for GDP in 2024, there is room for error there, right? And it wouldn't take so much to do that sort of thing. Maybe it's a geopolitical event. Maybe it's a resurgence in inflation. Maybe it's a government shutdown. I mean, who knows? Is this something that you're focused on in 2024? Because it's also what's different this time is that we have a new House Speaker. We know how quickly he can be ousted. We know why his predecessor was ousted for the very reasons of the deal that he just came to with Senator Schumer, right, the majority leader. And so we could see Majority Leader Johnson ousted and what that might mean for a government shutdown. And so I'm just curious, election year, there's a lot to really, kind of consider here. And is this something that you're worried about, Liz, as a strategist?
I mean, maybe this is a jaded take. I think market participants, many people have lost confidence that Washington is going to get things done in a rational and quick way. And we're almost used to the idea of, oh, here we go, another shutdown on the horizon. And it seems to happen every 6 months. In an election year, typically what you see, and this is the year that I think could be the political piece that changes what we expect to happen in any other environment. In an election year, you usually see during the primary season a little bit more risk of volatility just because there is uncertainty. We don't know exactly who the nominees will be yet. There's still debates going on. So during primary season, you see more of that volatility. But if you look at even just things like a shutdown, whatever the argument is that we're going through in Washington, in an election year, neither party wants something bad on their watch. So there is going to be a lot of political incentive to just try to keep that boat afloat. And it's possible that they do keep it afloat. Nothing big happens for the year because nobody wants to be blamed and nobody wants to have a reason to lose an election on their docket. So I think the political piece of this year, unfortunately, and this is an unfortunate part of being an investor, has nothing to do with the fundamentals of the company, has nothing to do with necessarily where we are in the business cycle. There just are going to be political incentives to keep some of this going. The other interesting piece that we haven't mentioned is that bank term funding program that's supposed to expire in March. If that is going to somehow cause a lot of havoc on regional banks again, I bet we see it extended. There's political incentive again to not take that away too quickly, which, by the way, the borrowing numbers continue to go up. So obviously there are banks using it. There is incentive to not take that away too quickly and be blamed for bringing the system down.
It's interesting about the political incentives in election year. The one thing I would say is that, House Speaker McCarthy was pushed out by the Freedom Caucus, and they clearly align very closely with candidate Trump, right? And so if you think about, I think their political incentives are to push for the sorts of things that align with his candidacy. And you might see, like some sort of shenanigans that, because if you remember in the fall, then candidate Trump was also encouraging the Freedom Caucus to be steadfast on their spending priorities. And the other issue is that this deal also has to come with funding for Ukraine and Israel, right? And so when we think about what's gone on geopolitically, I mean, that could really shape the landscape of this election year. We know that the Democratic Party seems to be splintered about support for Israel. The Republican Party is splintered for support for Ukraine, right? And, all of this comes down to, I think their priority is getting more spending for the southern border here in the U.S. So some sort of compromise has to happen, because I do expect Ukraine and Israel funding to happen. And the irony is, and this is me putting my political science hat on, is that I think that the Biden campaign is in a real pickle with some of the issues on the left here, and they really should probably just succumb to the southern border funding and get all the geopolitical stuff funded, the wars, you know what I mean, and shore up an area that they're kind of weak on, which is immigration for all intents and purposes. So again, this is not Meet the Press, but this is going to be playing out.
I'm just going to drink my coffee while you finish.
Yeah, over the course of this year. So that's going to be really interesting. Let's talk a little bit about the oil price here, okay? Because again, it found some support in the mid to high 60s, Liz, and some of the headlines this morning is that the Saudis in February are going to be cutting prices. We know that there's been some issues in the Red Sea with the Iranian-backed Houthi rebels. We've sent warships there to defend shipping routes here, and there's these issues are kind of tied, right? Because we are shooting up, I guess, some of these pirate ships or whatever you want to call them in the Red Sea. There was issues about shipping rates going higher, right, to get through there and the like and all the risks. But we also run the risk of a broader conflict in the region, right? So we know that the Israelis killed a Hamas leader in Beirut, Lebanon. We know that Hezbollah in Lebanon is backed by Iran. So we have the Houthis in the Red Sea that are backed by Iran. We know that Hamas in the Gaza Strip and the West Bank are backed by Iran. And what would a broader, a broader war in the Middle East mean, I guess, for crude at a time when the Saudis are cutting prices here? It seems like this is one of the ones that no one's going to be able to put their finger on until it happens. We are hoping that it doesn't happen, obviously, but crude oil today is down, and a lot of folks have just been wondering, like, why isn't crude oil higher given the heightened risk of a broader sort of escalation of a war in the Middle East?
Well, I think there's a couple things going on. I still think that the price is going to be more dependent on supply than it is on demand. But I think what's keeping it down is the fact that we're not expecting a huge resurgence in demand. If not, we're expecting a continued softening in demand, given everything that's going on around the globe and every country trying to control inflation. So there's not a huge expectation that demand is going to increase, not to mention demand out of China that I think we've been talking about coming back for 3 years, and it just hasn't. And China continues to have issues. So that resurgence of Asian demand as well, kind of falling by the wayside. So I don't think there's demand that's propping the price up. From this level, because it's a low level, and because if you look at just the trend, I was trying to pull it up while you were talking, just the trend over the last year or so, I mean, we're at about the lows that we've been at a few times over the last year. From this level, if there is heightened risk, if it does end up being a conflict that breaks out or gets worse than it currently is, I would expect a spike in oil prices, maybe just temporarily, but I would expect that to happen. And many people might say, well, from this level, maybe it's not that concerning, and especially if it's quick and short. That's probably true. But in an environment where we're trying to convince ourselves, and the Fed is trying to convince themselves that we've brought inflation down to a comfortable level and that it's going to stay there, it's going to be a tough thing to swallow. Now, of course, we take energy prices out of core measures of inflation, but I make this point all the time. Consumers can't just decide not to buy energy anymore. All the stuff that we remove from inflation is just the stuff that causes the problems. So it doesn't change the issue that even if oil prices do go back up, let's say gas prices go back up, let's say transportation prices go back up, airfare, all of that follows a spike in oil prices, the consumer gets pinched further, and that cumulative effect of inflation continues to be a problem through the year. So we don't want to see a spike in oil prices, but I think that from this low level and with everything that's going on in the Middle East, we are running the risk of that occurring.
Yeah, and I guess the irony is that at the start of 2022, when the administration was very focused on bringing inflation down, they were selling, I think, 20 million barrels a month. I think this is per Barron's. We'll put this in the show notes, from the Strategic Petroleum Reserve, right? And a lot of folks were critical of it at the time because that is not exactly the intended use, right, of that reserve. It really is for, in the case of geopolitical sort of events with, supply disruptions and the like, or whatever that may be. And so here they are now, they're buying, I think on average, maybe 3 million barrels a month at much lower levels. And so good on them. them, but it does seem like there is a soft floor. At least that's what this article is speaking to, because, it really hasn't been able to meaningfully go below $66, $67. Here we are today, just under $71 or so. And it would make some sense strategically to refill that reserve given all the issues that we have. But it's probably, not going too much lower unless there's a massive demand shock, right? And that would be something that, would give them plenty of opportunity to kind of refill that reserve. All right, well, that's one to keep an eye on. How do you feel about energy as a sector in general? It's down right now. I saw somebody on the street upgraded Chevron today. I know that if we look at the XLE, 40 or so percent of that is Exxon and Chevron. Both of those are kind of mired in massive M&A sort of transactions. There's been other M&A here. Guy would tell you that these companies are run much better. They can operate very efficiently with crude oil prices even down here. So is this a sector, like when you think about sectors this year, let's say that we are going to be in a choppy market for a while, and it could be one of those ones there is no definitive sort of range, because if rates remain volatile and uncertainty about the pace of cuts, right? And, we're going to have lots of sectors. And this goes back to what we talked about, in the beginning, the idea of like a sort of stock pickers market. Are there sectors to be bought despite, I guess, macro volatility here that you think you can kind of average into? Clearly, I guess, early this year where there's like the height of uncertainty.
Mm-hmm. Well, there's a couple things. So yes, I do think that there are sectors that you can look at. I would wait for a pullback, which maybe the pullback has begun. I would wait for a pullback in some of them that ran up quite a bit at the end of the year. But energy specifically, and full disclosure, I do take positions in sectors. I don't talk about individual stocks, as we know, but I do talk about sectors, and I do take positions in individual sectors, and I do have a position in the energy sector. And part of it is, it's not necessarily about the oil price. I watch the oil price as an indicator of cyclicality. I watch the oil price as an indicator of just risk appetite globally. It's one of the best global indicators of what's going on. And the behavior of oil prices, if you see that big spike and then a drop off. So if you look at the chart right now, it actually looks pretty pre-recessionary. And that's something that I look at just on a daily basis to track. But energy companies, to Guy's point, do trade quite differently. And a lot of those energy companies, the criticism years ago had been they're not making the transition from fossil fuels to clean energy. A lot of them have done a lot of work along that realm. And I think that they've come a long way. There are a few things that are going for the energy sector that have less to do with the energy companies themselves, things like the fact that energy did not do so well in 2023. So if you're looking for an opportunity to enter something that hasn't had that big run up, energy is one of those sectors. The other thing is, in a year where we would expect rates to continue falling, you're getting some pretty good dividends from a few of those companies. And I think dividend stocks are poised to do well in 2024 if rates keep coming down, because rationally, if you just look at, as an investor, what am I getting for owning this investment? Sometimes you're getting income. A lot of people are getting a ton of income from money markets right now, or treasuries. If rates fall, you're not going to get that income anymore. You're looking for income in different places. So you start to transition over into dividend stocks, and energy might be a big beneficiary of that.
Yeah, no doubt. And it's interesting to look at the XLP, which is the ETF that tracks consumer staples, the XLU, the ETF that tracks utilities, the way that they both fell off a cliff in September, right, as yields made that move towards 5%, and then they did the inverse, right, when yields came back from 5 to 4%. So they seem to be at a little bit of an equilibrium. And so really pick your poison as far as which way you think yields are going and how you want to be exposed to kind of dividend yield, because obviously these are going to act as the inverse of that. Lastly, before we get out of here, let's talk about banks, because Q4 earnings season is going to get kicked off Friday morning before the open. And if you think about it, I think like 30 or 40% of the XLF is reporting Friday morning. JP Morgan, Bank of America, Wells Fargo, Citibank. I think BlackRock is also in there. And it's interesting. I was looking at the XLF, which is not a great indicator of the banks. We know the largest holding is Berkshire Hathaway, but the implied movement on just this week is a little less than, or a little more than 1% in either direction. So if you were looking to buy an at-the-money call or an at-the-money put that expires on Friday's close, right, that's going to incorporate all of those those earnings on Friday morning, but obviously movement between now and then, you were really risking like 0.5%. Your break even on at the money is a 1%. I mean, that seems like a pretty cheap way to either hedge an existing portfolio, individual names, or whatever directional view you want to take. What are you expecting out of bank earnings? We know that this move lower in yield should help some of those, like a Bank of America, which is outperformed, and a Citigroup that's outperformed, where there was thought to be some issues in their kind of held to maturity, mark to market portfolios, right? One of the reasons why they underperformed great deal on that move in yields higher from 3.5% from that March period of the SVB crisis and the like to the highs of 5% in the 10-year. They're going to have good marks for Q4. But what are they going to have to say about Q1 guidance or for the balance of the year? Because they don't have a whole heck of a lot of visibility. And I think the rate volatility is going to be specifically felt in the money center bank grouping for the balance of this year.
Yeah, so we talked about this last week, I think a little bit. I am positive on financials, at least for the beginning of this year. I want to say the first quarter and not extend out too long. But part of that is the idea that if and while economic data holds in and stays steady, you've got a little bit of a tailwind, if not just a floor on cyclicals, right? And financials being one of those cyclical sectors. And if rates continue to fall, if we see a re-steepening in the yield curve, they do have a benefit just from the net interest margin perspective. So to your point, yes, the fourth quarter, I think we're probably going to hear good marks from them, not to mention banks are up, as we mentioned, 20% since the end of October. So capital market activity was positive for them, and yields coming down on the longer end, positive for them as well. So I think there probably were good things that happened in Q4. This year, I think we're going to see even further divergence among just those big banks. So last year, after the regional banking crisis, you saw them trade together for a while because they benefited from the regional bank issue. This year, I think they trade apart. And I'm not going to make a call on who's going to do better and who's going to do worse, but you do have to parse through what their business models look like. Bank of America, more exposed to consumer lending. And then you've got other companies more exposed to capital markets activity, right? Somebody like Morgan Stanley or Goldman Sachs, more exposed to the M&A cycle. So I think what we're going to hear from CEOs is their outlook on their specific drivers. So you're going to hear about capital markets activity from the ones that are dependent on capital markets activity, right? And they're probably going to choose the things that could drive their stock higher. This week, just because of what's happened over the last quarter and because of some of the upgrades that have happened in Citi, for example, a lot of times with bank earnings, it's not so much about the earnings, it's not about the results, it's about what the CEOs say on the call. As usual, Jamie Dimon, I'm sure, will make some news, and he's obviously one of the most listened to CEOs, so that one will always be at the top of the list to listen to. But I also think it's going to be interesting to hear what Citi has to say. They've been upgraded by a lot of different analysts, and they've made a ton of changes. So I think there's going to be probably more ears on that call than usual.
Yeah, no, it's interesting. I was looking at the BKX, which is up about 35% versus the XLF, which is up 20%, from those October lows. The BKX is still down 35% from its highs in late 2021, which I do think is interesting. And on a market cap basis, that is a whole heck of a lot more than it's gained in that 35%, right, off of those recent lows. So long ways to go. It's just under $100. I think it was very near 150 a couple years ago. I will say this about JP Morgan. It seems like while people chased the beta of a Citi and a Bank of America, right, as rates came in, they thought that was the trade. If you look at the move in which JP Morgan had from its October lows to its recent highs, it was up 28%. So much more capital flowed into JP Morgan on a market cap basis. And you look at the steepness of that rally and just the steadiness of it. To me, I just don't know what Jamie Dimon is going to be able to say, or I don't know what his incentives are to be overly optimistic, especially at a time where he's been very pessimistic over the last year and a half about the economy, about the direction of rates. And what he's had to say about rates is flies in the face of what we've seen over the last couple months. So I just see a very, very steep uptrend. I see a retracement in JP Morgan probably back to 160. It's trading just above 171 or so right now. And might that lead the sector a bit lower? Because I think, if anything, taking some of the froth out of some of these sectors that have outperformed from those October 27 lows makes sense, especially when you consider where the market got as far as rate cuts relative to the Fed's dot plots, relative to what a lot of these Fed speakers have been saying over the last month or so, I think equity markets have priced in a whole heck of a lot of easier monetary policy that might not just come. So we will see. Liz, you're going to be back with Guy and me on Wednesday on the market call. That's going to be excellent. Last time you were on Wednesday, we took a bunch of calls for a half an hour. That was a lot of fun, right? So
let's do it again.
That was a lot of fun. We really appreciate you being with us early on a Monday morning. We covered a lot of ground. I'm really happy for you and your Packers. And obviously your Bucks are doing well. Let's see what your Brewers got in store for this spring.
Okay, one team at a time.
Yeah, we got a lot going on, but we like our listeners, we like our viewers to know where you're focused on when you're not focused on the markets, because it's all thing Wisco sports. So we appreciate it. Thank you, Liz. I appreciate it.
Thank you.